Hey guys, it's Miss Vinson. Today we're going to really start talking about firms. Now, up to this point, a lot of our discussion has been about households. If you remember the circular flow model, we've talked about consumers maximizing their utility. We've talked about what happens to consumers whenever there's a tax put on the market. We've talked about how strong consumers react to a change in price or a change in their income. So we've really been focusing on consumers and households. Now we're going to flip to the other side of the circular flow model and spend some special attention paying attention to firms and businesses. Now, the number one thing that businesses want to maximize, they don't care about utility. Businesses and firms want to maximize their profit. So the primary goal of firms is to maximize their profit. And that should probably come as no shocker to you. Now let's clarify what we mean when we say profit. Profit is the money that's left over from a business's revenue after they have paid their cost. Remember, we've already talked about total revenue, and that's the money that a business is bringing in when they sell stuff. But they don't get to keep all that revenue. That's just what they bring in. What are they going to do with that money? Well, they got to pay some of their bills. They got to pay their workers. They got to pay their loan cost. And so once they've paid their cost, then whatever's left over, that is their profit. That is the money that they get to put in their pocket and walk away. And that is what they're trying to maximize. So we're going to spend a lot of time in these next couple of weeks focusing on how businesses can maximize their profit. But today, we're just going to start off by talking about different types of profit. There's an accounting profit, an economic profit, and a normal profit. And to understand what's the difference between those types of profits, we have to look at the difference between explicit and implicit cost. An explicit cost is what we most commonly think of whenever you go and actually spend money. So when a business actually spends money on something, that is known as an explicit cost. So if they're writing a check or the money is exiting their account when they're buying something, that is explicit cost. So you can think about explicit cost as expenditures, money that is actually exiting the business's account. Well, what other kind of cost is there besides money that you're paying? Well, there's money that you could have had if you were doing something differently. That's known as your opportunity cost, or in this case, we're going to call it your implicit cost. So implicit cost, it's not the money that you're spending, but it's the money that you could have had if you were at your old job or if you had used your resources differently. So implicit cost is like money that you're giving up, very closely related to opportunity cost. So let's tell a story about Thomas. Suppose Thomas quits his job as a news reporter, earning $60,000 a year, to open up his own soccer supply store. Because, let's say he used to play soccer, he loves soccer, he coaches soccer for kids, and he really doesn't want to be a news reporter anymore. He just wants to open up his own soccer supply store and be around that all the time. Well, to do that, he had to pull $10,000 out of his savings account. Now, that $10,000 was earning him $250 in interest every year when he had the money in the bank. So I don't know if you know too much about banks, but when you have money sitting in the bank, you are earning a little bit of interest just by having your money sitting in an account. So if Thomas had just left his $10,000 in the bank that year, then he would have had an additional $250 that he had earned in interest from the bank. But since he took that $10,000 out, he is no longer going to earn that $250 in interest. So let's look at the cost we have in the story so far. What has Thomas given up? Well, he gave up the $60,000 salary that he could have had if he had stayed at his old job. And he also has sacrificed the $250 in interest that he could have had if he had just left his money in the bank. So when he goes to start his own soccer supply store, he spends $30,000 on supplies and inventory. He spends $20,000 in that year on rent for the store space, and he spends $40,000 on workers' salaries, so on labor, because you got to have somebody working at the store. This is money that Thomas is actually spending for his store. So this is money that's actually exiting his account. So these are known as his explicit cost. I mean, he could probably show the receipts for this money that he's spending. These are his actual expenditures. So if he's spending $30,000 plus $20,000 plus $40,000, then his total expenditures, his total explicit cost is $90,000. So just looking at explicit and implicit cost in this example so far, the explicit cost in this example, what he's actually spending money on, is $90,000. He's actually spending $90,000 on his store in this problem. But his implicit cost, what he could have had but has now given up, what has been foregone, is his salary plus the interest he could have made. So $60,000 plus $250. So $60,250 is his implicit cost. Now, why do we even have to have different types of cost? What's so important about being able to classify explicit versus implicit cost? Well, it's going to make a difference in the type of profit that we can find. There are 3 different types of profit. There's accounting profit, economic profit, and then there's normal profit. First, let me tell you about accounting profit. Accounting profit is what most people commonly refer to whenever they're just trying to say how much money they earned in profit that year. So think about an accountant. Now, I may have a stereotypical view of an accountant, but when I think about an accountant, I imagine this little guy with glasses and a bow tie, and he's kind of leaned over his desk, looking at his notebooks, looking at his ledgers, and he's comparing the money that's coming in and the money that's going out. He's trying to balance the books, all right? He's the bookkeeper. And so when we talk about accounting profit, accountants only care about the money they can show coming in through sales receipts, that's the revenue, and the money they can show going out, which is explicit cost, because you have receipts for money that you've spent. So accountants don't care about what you could have had or what might have been. They only care about show me the money. Show me the money coming in, show me the money going out, and I'll tell you your profit. So accounting profit is simply total revenue, which is all the money you have coming in. Remember, it's price times quantity, minus just your explicit cost. Accountants only care about what you're actually spending. This figure is going to show you how much money you're bringing home to survive on. Accounting profit shows you how much money you're bringing home to put food on the table. So you want your accounting profit to be a decent amount of money. Now, even though accountants don't care about what you could have had, you know that economists do, right? I mean, economists care about your choices and are you better or worse off with this option or that option. So when we talk about economic profit, our second type of profit, economists do care if you're better or worse off. Economic profit does not show how much money you're bringing home to put food on the table. Economic profit shows if you made the right choice when you used your resources in a certain way. Remember, because economics is all about choices. So if you're trying to figure out if you are financially better or worse off in this new situation versus your old situation, then you still need to think about the money coming in and the money you're spending. But you also have to consider what you could have had if you had stayed in your old situation. So economic profit is total revenue minus both costs added together, minus your explicit plus your implicit. The reason why implicit has to be added in there is because we're trying to figure out how much money you could have had if you had stayed in your old job, which is going to help us figure out if you're better or worse off in this new situation. Now, since economic profit has 2 cost values coming out of total revenue instead of just 1, economic profit will always be lower than accounting profit. But is it okay for your economic profit to be $500? Sure. That doesn't mean that you're only bringing home $500 to live on. That means that you are $500 richer in your new situation versus your old situation. So as long as your economic profit is positive, that means you're doing better in your new situation versus your old situation. You made the right choice. If your economic profit is 0, that's not a bad thing either. If your economic profit is 0, then that means you're doing just as well in your new situation as you were if you had stayed in your old situation. So when you think about economic profit being 0, you can think, well, I'm kind of just the same. I'm breaking even. If your economic profit is negative, Now that means you're actually financially worse off in this new situation. You actually would have been richer if you had stayed in your old job or stayed in your old situation. So your economic profit shows if you made the right decision with your resources. And then finally, we have normal profit. Normal profit, real simple, easy concept. Your normal profit is always going to be the same thing as your implicit cost, because your normal profit is the amount of money that you should reasonably be able to expect to earn. So if you quit your job and you open up another business, you want to at least have as much money as you had in your old job, right? You want to at least be that well off, if not better. So your normal profit is the same thing as your implicit cost. Now let's finish up this scenario with Thomas and his soccer supply store. We figured out his explicit and implicit cost, but what we need to know now to figure up his profit is how much money he's bringing in, what his revenue is. So maybe in his first year of business, he brings in $160,000 in total revenue. So first, let's figure up his accounting profit. His accounting profit is going to be his total revenue, which is $160,000, minus the money that he actually spent, his explicit cost, which was $90,000. So $160,000 minus $90,000 is going to be $70,000 that he's bringing home to put food on the table. So his accounting profit is going to be $70,000. Not too bad. He's definitely not going to be eating ramen noodles, right? But did he make the right choice? Should he have stayed at his news reporter job, or is he better off with his soccer supply store? Well, we have to do economic profit to figure out if he actually made the right choice, because we have to consider what he was giving up. So Thomas's economic profit is going to be total revenue minus his explicit plus his implicit cost. So that's going to be $160,000 minus $90,000 plus $60,250. Well, that's only going to leave him with an economic profit of $9,750. That's a really great thing. That means he's actually $9,750 richer with his soccer supply store than if he had stayed in his old news reporter job. He definitely made the right choice. He's definitely better off. And if we wanted to figure out what his normal profit would be, well, okay, how much profit could Thomas normally expect to make if he had stayed at his old job and left his money in the bank? Well, probably $60,250, right? That's the money he would have had if he had stayed in his old job. So that's what he can expect to get. So it's normal for him to expect at least that amount of profit, because that's how much he would have earned if he had just stayed in his old situation. So normal profit is just the same thing as your implicit cost. So we're going to work a few scenarios in class. You're going to be able to pick out explicit and implicit cost and accounting, economic, and normal profit. And students generally don't have a lot of trouble with this after a little bit of practice. So until then, guys, I'll see you later.